Welcome to the Retiring Real Estate Investor Podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice, and nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Hello and welcome to the Retiring Real Estate Investor Podcast. I'm your host, Brandon Bruckman. I'm excited to be joined by Scott Carson today, the Note Guy. That's what you're affectionately known as. That's why I found you on LinkedIn, the Note Guy.
That's exactly it. It's not me doing that. It's actually students of mine. It's funny. Back in 2010, I was kind of traveling and I actually was speaking in a lot of investment clubs back then. And I went into one club in San Antonio and said, "Hey, you're that Note Guy on YouTube." One in Austin, same thing in like 5 minutes. And I was out in California and San Diego and LA in back-to-back nights. The same thing. "Hey, you're that Note Guy." It's like, well, I guess that's branding. If they tell you what they're going to call you, might as well run with it. You know what I mean?
Boy, that makes it easier, doesn't it?
It's like, "Hey, you're that asshole. You're that Note Guy. I'll take that." You know what I
mean? As long as they remember me, I'm good. We'll be okay.
Exactly.
So we're going to learn all about note investing, and I really want to get into that. These are the most exciting episodes for me because one, I want to learn. I want everyone listening to learn. But I'm also overtly curious about this area, and I don't feel like I know enough. So I'm excited I'll be taking notes too, and trying to learn a little bit. So Scott, maybe start the folks off with, how are you coming at this space? Where did you come from? What got you introduced to note investing? Give us a little background.
Yeah, so I'm a previous financial advisor and banker with Bank One and JP Morgan Chase. I guess you'd say would be my official grown-up jobs back when I first started in that. And then I left the banking industry and got into loan origination. Started a mortgage company with a buddy of mine, traveled the country working with investors. And for 4 years, from really 2004 to 2008, I had an apprenticeship with a guy by the name of Bob Leonetti and a lady named Jamie Kayla. They were partners. And they were going around on the Ron LeGrand investing circuit, teaching creative financing, creative real estate investing, subject to deals, wraparounds, all that good stuff, and owner financing. And that's what most people think about note investing is you're going to offer terms or owner finance a property. And that's one little small aspect of note investing, a very, very small, minute aspect of things. So I learned all this creative real estate, started investing on my own, doing deals the right way. And then in 2008, when everything hit the fan in the mortgage industry, I sold my half of the mortgage company for $1 and went out, instead of going out and trying to figure out what to do, I started picking up the phone and calling banks and lenders and started saying, "Hey, what kind of naughty notes do you have on your books? What kind of borrowers do you want to get rid of?" Because that's what I do, basically. That's what my niche of note investing is I actually buy mortgage notes. I buy debt direct from banks, lenders, hedge funds, institutions all across the country. They send me their lists of bad borrowers who aren't paying usually. And we cherry picked it by buying the debt. And when you buy the debt, the note, you don't own the property. And that's one big clarification I want to make for investors out there, is that they think, "Oh, I'm a bond and I don't own the property." So no. You're just out and became the lender, and you have all the rights that a bank does to work with that borrower or not work with that borrower if they won't play ball with it. And so that's what we do is when we buy this debt, we're buying it at a dramatic discount, usually 30, 40, 50% off of either value or what's owed. And we make our money by reaching back out to the bar and say, "Hey, what happened? Tell me your country western song. I'm not the previous lender. You've got a fresh start with me. If you want to stay, great, but you got to pay something. We got to figure something out that makes sense. And if you no pay, stay. We can either make it a friendly and let you kind of walk away with your head held high. We'll forgive you the debt. Maybe sometimes we'll give you cash. But if you're not going to play ball with us, then we still have all the rights that the lender does. So then we'll throw it with our attorneys and let them battle it out in court to foreclose at that point. But that's kind of what we do. In the last 15 years, I've bought over $1 billion in distressed debt, closed on thousands of deals, anywhere from a one-off note for $7 all the way up to $1 million asset, or tapes of 100, 200, 300 assets at a time. So that's what I do. Our biggest goal is not to actually take the property back. I love your show, The Retired Real Estate Investor. So many folks are dealing with retiring. You don't want to create another job. So our biggest goal is to buy this debt and actually turn it into cash flow by keeping people in their houses if they can. So hopefully that answers a little bit my background there.
Oh, big time. And you inspired 16 questions. Here they come.
Bring them on.
I'm going to let you get a drink first, and then we're going to fire away. Talk about origination a little bit. You're buying it from banks, maybe other private equity, hedge funds. Talk about that process and sort of the marketplace. I imagine that marketplace is competitive.
Yes and no, it can be. If you're originating notes, there's a lot of people that are creating notes and then selling that stuff off. You have mortgage companies, stuff like that. But the non-performing side isn't nearly as competitive as you think it would be. Especially, don't get me wrong, we're not going out and fighting JP Morgan Chase or Citibank for a $50 million portfolio. That's what they buy and that's what they sell in. So that's fine. We make our living and make our big bang by, it's like, I guess you could say, take a term from Jonah Hill from War Dogs. We live on the crumbs. All right. There's plenty of banks out there or lending institutions that have 1, 2, 10, 100, whatever notes that are on their portfolio that they need to get off their books. They can't, for some reason, work with a borrower. And for every bad loan on a bank or lending company's book, it really costs them 10 to 100 times that in fees collected. So they would rather get that note off their books, get 50, 60 cents of what's owed, than be able to take that money, go out and relend it out and recycle their money, and let us take over that problem child and try to work it out and make it from there. But it's a smaller niche. I mean, especially when you compare it to like fix and flippers or wholesalers or landlords or, everybody's out there is looking for property. Well, with what we're doing, it's a smaller niche, maybe really, truly 40, 50,000 people total across the United States. And not everybody is focused on the exact same asset class or type, so it narrows it down quite a bit. Non-performing is a smaller niche within that aspect of things. And especially depending on where you're buying at. Some people want to focus on 1 or 2 states, their backyard, and that's very narrowly focused. I'm in Austin, Texas, but I don't buy much stuff here in Texas. It's just a expensive state because of fast foreclosure timeframes. We have the fastest in the country. So I find a bigger bang for my buck, and I can leverage my money out because I'm buying in Ohio, Michigan, Indiana. I will buy also quite a bit in, as I say, God's waiting room, Florida, for those that want to retire someplace sunny. Georgia, the Carolinas. We do a mixture of judicial and non-judicial states. Some are faster foreclosure. Some can take up to a year. The states you really want to avoid are like New York and New Jersey, which can take you 2 to 3 years to foreclose and then forever to evict.
So it's interesting here. There's the crumbs, and that was a great analogy, the War Dog analogy of the crumbs there. Go see that movie if you haven't, and you'll understand what we're talking about. But even inside that, it sounds like there's niches in there too, where you can continue to focus on. And this is, I try to explain to our investor class and our investors, there's some pieces of natural economics here that occur, and some of it is scale.
Yep.
And it's this broad, and please correct me and add to this, there's this broad thing of scale where a bank like JP Morgan, I don't know how much assets it has on a balance sheet, but it's quite a few. And laws and numbers say it's easier for them to offload this small stuff that's a problem. It's not economical for them. But you and I look at it and go, this is a tremendous return for me because I have different scale than they do. There's a way to create economics in that, correct?
Exactly. And I'll give you a great example. Back about 10 years ago, we were bombarded with HUD foreclosures. I don't know if you remember that. There was a lot of people buying HUD foreclosures. Well, then suddenly, like almost overnight, that the HUD foreclosure faucet turned off. And the reason it turned off is HUD said, we're no longer going to be taking these to foreclosure. We're going to sell the debt off. It's actually easier us to sell the portfolio that's non-performing loan off to investors like me or in smaller pools to other people because we get our cash done. It's all done at once. And then us as investors, we have that flexibility based on knowing the markets and know what we're looking for to be able to go in and negotiate or work things out more effectively and turn what a bank is a non-performing asset. Well, if we bought it at 50 cents, we got a lot of flexibility to then go to the borrower and say, hey, we'll work with you now. Maybe the other bank was willing to work with you, but let's get you back on track. And that's, if you don't want to do that workout, that sounds like a lot of work. We don't do it myself. There's servicing companies, attorneys that help out with this. But a niche that has evolved from this non-performing wave that we saw from 2007, 2008 through 14, and then it's starting to reappear with non-performing stuff, is people like me who have bought non-performing notes, got them back on track, and have them reperforming for 12 months or greater. And now we can sell that to other investors or people looking just for pure cash flow or pure passivity with their investments instead of having to be more active. So there's a couple.
So how do you?
Go ahead.
Yeah, sorry, I took you too far. I want to go back a little bit. So you're finding these banks. How are you determining they have what you want? Because I imagine you're not buying. Are you going through and buying loan by loan? I would imagine you're buying a book of those loans. How are you evaluating that?
Great question. We evaluate lenders on a couple ways. One, sometimes it's just the shotgun approach. Like I've got a database of asset managers, and you're not going to walk into the local bank and just say, hey, I want to buy notes. That's not the right person. Okay. They'll call security. We got a crazy person out here, because I used to be a banker and people would come in to Chase Bank. So I want to buy your notes. I'm like, we don't sell our notes. Well, Chase does, but they're just going to sell them in such a big portfolio. They're not going to deal with you. But the banks have these internal departments called secondary marketing or special assets department. They're often in a different bank or building, but we just do two approaches. One, we do a monthly drip marketing campaign out to asset managers. Hey, what do you have on your books this month or this quarter that you're looking to get rid of? And it may be one note, or it may be 1,000 notes. Some banks sell every month. Some sell just once a quarter. Some sell once a year. Sometimes we get tapes in if they want to take us to take it all. Sometimes we can. And we'll kind of, if we've got to take a whole portfolio, we evaluate it kind of in three phases. The top 25% is usually what we want to, if we sell that stuff off, we want to make sure we make back most of our investment on that portfolio. We make the most amount of our profit from the middle 50%, and we may lose on the tail of the trade. The bottom 25% are just break even on that stuff. But most banks, though, will let you cherry pick. They'll let you take a look at a portfolio and do a carve out, a one-off note, or you can do a mini bulk, or like I'll give you an example. We got a tape in 2 weeks ago, 422 notes from a servicing company, made an offer on 65 of them. 35 of our bids were accepted. And out of that 35, we may end up just, closing on half of those because we'll eliminate some of these during the due diligence process. So we'll look at the values of the property. The value matches up with what we thought initially. Great. If the condition is shittier than we thought it was, we may kill it. If the servicing notes show that the borrower may be just a pain in the ass, because we'll be able to really see behind the curtain, see if that borrower has been friendly. If they're friendly, great, we'll take it. If they've been like pound sand, they'll drag stuff out, we may not want to do that depending on the state that it's in. But then also looking and seeing, what's the collateral look like? Some lenders are really good about keeping the loan files clean because that's really kind of what we're buying. This is what we're buying, this loan file, not the actual property, but this actually controls the property. So we'll look at that, make sure everything's in there, that we have all the documents, the right to foreclose. We'll review it with the attorney and make sure we're not violating anything, and then go from there. So it's a little upfront due diligence on values and numbers, running some formulas on the spreadsheets, or as they call it, the tapes, identifying what we want in the states we want, locations we want. We kind of avoid very rural assets because it's harder to get people out there, but then we make an offer, and then it's all about negotiating back and forth and going from there.
Gotcha. So there's a ton of information here. You're not flying blind when you're buying one of these portfolios. You're really sorting through, even down to who that borrower is, and understanding their behavior. You're able to understand that in these notes. That's a ton of information.
Yeah, it's really three phases. You look at the property, you look at the collateral file, and it's the borrower. I mean, even like looking at their social media. We do a little social sleuthing or borrower stalking to see what's going on. I mean, you can see notes like, if we get the collateral file, a scanned copy, we can see if the borrower's like, hey, I'd really like to stay. I'm trying to do a modification. We've gotten loan files where the borrower's applied for a loan modification 4 or 5 times and been rejected because the loan's been sold, But when I see something like that, I'm like, this is a borrower that wants to stay. I will buy this note today because I know based on what they tell us, I can kind of calculate my quick ROI and give you a bit of an idea on that. If it's gonna be an occupied asset that we think will get reperforming, we want to shoot for at least a 12 to 15% cash and cash return based off on either there's just a pure reinstatement, and that's not including any extra they might bring to the table. If we know we're probably going to foreclose, we want to see somewhere around a 20 to 25% because we don't get interior access to these properties. So we know we're going to have to do a little bit of upkeep. So we shoot for a higher ROI, knowing that we'll probably end up somewhere in mid-teens or 20% if we have to foreclose and then sell the asset off.
What you said earlier is very interesting. The goal here, and it sounds like the best economics and the smoothest process, is to get that note performing again.
It's our number one strategy, and it's so opposite of what a lot of investors come to the table. Like, I want to own the property. I want turn it into a rental portfolio. Or I want to add it to my portfolio. And that's great. There are advantages to owning the real estate over the notes. And then note investing has advantages over the owning the real estate. Tax, we don't get a write-off depreciation on a note deal, but we do get a write-off what we forgive in the debt aspect of things. So,
okay.
But something the biggest bang for the buck, and numbers don't lie, is if you can buy a note and get a borrower back on track in the first 30 to 60 days, and they start paying you monthly cash flow, and you're making money because then you're paying your investor, and we fund this with OPM and other people's money, so we're paying back our investors a flat return. But if you start looking at, you mean I can control a property, get cash flow, the value's appreciating, I'm going to take advantage of that. I bought the debt at a discount, and so the value's going up on that note every time they make a payment. Without having to do any toilets, tents, and trash outs, or any rehab or waiting around, that was one of the big mistakes I made early on, Brandon. When I got into note investing, I came from the real estate side. I was like, I got to foreclose on everything. No, I had no empathy. But when I should look back, I was like, man, I left a lot of money on the table if I just modified it.
It's so interesting there that if we can make money and do some good at the same time, that is truly the win for everybody. Because you're talking about keeping people in their homes. This is probably a mortgage that someone have gotten behind on. They've probably gotten little to no contact from the bank or the servicer at all, right? And there's been no help to do that. Can you imagine the pressure that's on that particular person or their family? And then you come strolling in and say, hey, I actually want to make sure you stay. Let's find a way to do that. And that's the best economics for you as well. That's a pretty good deal.
It's a great deal. I mean, and the great thing is we're about able to help. I'd say somewhere around 65 to 70% of the borrowers and stuff that we buy, where they're occupied. If it's vacant, we know we're going to foreclose or deed loan. They've already walked away, but they're still staying in the house, and they have the means to pay a payment that makes sense. If some people are like, oh, my mortgage payment's $1,200, I can only pay $200. Well, we can't accept that, man. Come on. That just doesn't make any economic sense. Let's give you some cash to walk. You just don't, honestly, let's get you out of this bad situation. 2 years from now, if you pay everything on time, you'll be able to buy a new house at that point. Let's get you back out of this bad situation. But one of the great things as you look at is if you take an actual property to foreclosure, it just doesn't affect that borrower. It literally affects the neighbors, the street values, the zip code. It's really a negative impact on it's like a ripple effect. You drop a stone and it ripples throughout the whole thing. But if we can keep a borrower in a house and get it back up, it keeps the value of the property, keeps the value of the neighborhood, actually maybe appreciates it some because of, who knows, in 12 to 18 months, maybe they can refinance out, or now they can stay in their house or sell it off at full value versus losing at the foreclosure auction in a lot of cases too.
Yeah, 100%. How long does that process usually take? So you're going from you've identified a note, you've gone through due diligence, you decide you want to buy these notes. What's that timeline from I've purchased this, I'm ready to start working on it towards working those out? I realize it varies, but what's sort of the average timeline on something like that?
It's a great question. On the front side, it's about 30 to 45 days from the time that we look at a tape to probably the time that we're closing. Okay. And then it varies a little bit. Servicing companies, when they're reaching out to borrowers, and that's what you have to have a licensed servicer in that state, unless you want to be a licensed servicer and you don't want to jump through the hoops and pay the fees for that. So, we're paying a servicing company anywhere from like $25 a month up to $90 a month for a non-performing one. So usually what will happen is you start to reach out immediately to make right party contact with the borrowers, and that you try to do that within the first 30 days. I speed it up a little bit. Most loan files and things aren't going to transfer for at least 2 weeks, because you got to give the borrower time. There's a goodbye letter that goes out and a hello letter. Hey, thanks for not paying. Now you got to pay these guys, kind of thing. We speed that up a little bit. We actually, a week after we fund, we actually send our own letter out, say, hey, we're now your new lender. Okay. let's get you in here. And a lot of times that speeds things up, because if you got people that want to stay, they'll immediately reach out. I really do want to stay. Great. Let's get this modified. Let's put some terms in place, even before servicing is transferred in 30 days. So that's kind of a nice thing. Of course, we've had borrowers that we started the foreclosure process and they came to the table. I'll give you a great example. This is a deal that just happened the other day. One of my students in Arkansas, and he's looking at this. We came across this note on set. It was a double wide mobile home on 17 acres of wooded land and outside of Little Rock. The property's worth about $100,000. The guy owes $86,000 on it. Hadn't paid in about 3 years. Why the bank hadn't started the foreclosure process, don't know, but I think it had to do a little bit of COVID, and they just fell behind on the paperwork. So foreclosure is supposed to happen. Keith closed on this last week of December. Paid $56,000 for this deal. Okay, he's like, I'm in a good situation. If I foreclose and sell at the auction, I'll sell it at 86 because that's what's owed. I'll make $30,000. If I take it back, I'm happy. I got an asset that's worth $100,000, and I'm in at 56 cents on the dollar. Didn't expect the borrower to come. Well, 2 days before auction, the borrower calls the attorney. The borrower calls the service to say, hey, I really want to keep this. I can bring $25,000 to the table to reinstate the loan. Would you allow me to do that? And Keith's like, hell yeah. I don't want another job. Sure. So borrower had borrowed money from friends and family, whatever, wired $25,000 to the table. Keith's $56,000 investment just got $25,000 this month in the first 30 days, which is great. Doesn't always happen. But now going forward, he'll now collect a monthly payment of, I think, $780 or $860 a month, that's a dang good little return for him on that money. And he used his self-directed IRA to fund the deal too, so it's all tax-free growth.
I wanted to ask you about, that's a great story. I wanted to ask you about that. You alluded to it earlier, is how should we think about this from a tax perspective? It sounds like if you can push this through a solo 401k or something where you're self-managing, a tax-free type of account like that, it sounds like that's the best method.
Oh, always. I mean, if you can get away without having to pay Uncle Sam and tax-free growth, heck yeah, it's the great thing. The way the notes work, it's two cases. I'll give you a great example. One of the things that you have to be careful of is if you modify a loan, you buy a non-performing note, and let's say that the borrower owes 100, you bought it for 50, and you modify the loan to 90. Okay, if you do an immediate in less than a year, Uncle Sam wants to tax you on the full 90. Even though you haven't received that, you have to send in have a third party, I won't say appraiser, but evaluation company come back and say, no, it's not worth 90, it's only worth 50 plus what they've paid. If you do a trial payment plan for 12 months, that means you're basically say, hey, if you make 12 months of payments, then after 12 months, I'll modify. That's okay. They'll treat that as a long-term capital gain at that point. Okay. But anything that happens in less than a year, it's a short-term capital gain.
Gotcha. I should preface this with, I don't know if you are, Scott, but I'm certainly not a CPA. So discuss this with your tax professional, please, about how this works. But understand, this isn't the same thing as owning the real estate, right? There isn't depreciation, all these wonderful other tax law and codes that we can follow to do this. However, based on your story, I mean, there's opportunity for, you won't mind paying the tax if you're making a bunch of money.
Well,
exactly. There's ways for you to mitigate.
Exactly. And you always talk, I mean, that's a great thing. We run everything through our attorneys, our servicing companies. You definitely want to have an accountant or bookkeeper who understands the ability to write off debt. I mean, if we forgive $30,000, we can send it, we can 1099 that borrower for the forgiveness. And here's a little trick. I want to tell you this right now. For those that own real estate, most people don't know about this, but instead of chasing your deadbeat borrowers who haven't paid rent and then you evict them and then try to go after it for a deficiency judgment, screw the judgment. Just send them a 1099 for what they didn't pay any repairs on the property. It becomes an immediate write-off, and then they got to pay taxes on that money.
There you go. You just made that process a heck of a lot easier too.
And
A lot
especially
of
with being
folks
the
are
end of the
listening.
year now, it's like people are like, "Oh my gosh, I got it. Oh,
Yeah.
what? Yeah, you're never going to get collect from these people. That's fine. Still file that. You still get a judgment put again, but 1099 for the lost income, man.
Yeah, I think this is the time of year than last month where folks are looking at some of those numbers and going, "Oh, I got some work to do
Yeah.
on some of these tax bills for sure." This is awesome. What am I not asking about note buying that it should be?
So you're not. Let's talk about how do you find or how do you buy these deals, because that's probably
Yes.
a better thing. How do you fund these things? You're not going to go to the bank and get a loan to buy a note. Now, if you've got a business line of credit or a line of credit, yeah, you can borrow against your line of credit for sure.
I'm scratching this off my to-do list. Don't walk to the bank around the corner. Don't ask them if I can borrow to buy their notes. Gotcha. Okay. What should I do?
Well, here's the thing. If you've got capital, you got your own cash, your own IRA funds, that's great. I always tell people, like, don't use your own money, because there's no return on investment that beats infinite, right? And so if you're using other people's money, and we use about 95% of the funds that we use come from like IRA accounts, self-directed IRA, solo 401k, stuff like that. That's a great way to give somebody a decent return, 6 to 8% on their money passively, and you're out making usually double that return without having to use your own funds and holding it for cash flow. Most people think, oh, a note, I got to be into it for 30, 40, 50 years. No. We usually structure our deals to be roughly 3 years, because it'll take us, if it's a performing note, it's going to take us at least 12 months of on-time payments to get that note back considered reperforming. And then we've got options. We can keep holding it for cash flow, or turn around and sell it to Wall Street. If we bought it at 50, sell it at 85, 90 cents on the dollar, cash out our investors, you pocket the capital, or go back and go double down now. Take the money and profits and buy 2 or 3 notes with what we did with one. But using other people's money is the best way. In any type of real estate investing, it's great that you've got your own funds, but honestly, everybody uses other people's money, including like Warren Buffett. So make sure you leverage it. And IRAs is one of the easiest asset classes for self-directed IRA companies out there to use.
So there's 2 questions I didn't ask you about notes that I remembered now that you're telling me that.
Bring it on.
What does the current environment look like? I would imagine that pre-COVID, let's say, and COVID maybe, there probably was a little bit less supply in the marketplace. I think it's probably hard for people to default on or get in trouble on their mortgage when it's 3%.
You would think so.
Or am I guessing wrong?
So yes and no. We had a little bit less inventory prior to COVID because values were increasing. People would just sell their house in a lot of cases. If those that could, if you go late on your mortgage, you're not going to get refinanced out. No mortgage company is going to refinance you out if you've got one later, more than one late in 24 months. But you got to realize, we're not just looking at the stuff that's been originated in the last year, 2 years. We're looking at the 80 million mortgages across the country that are, at any given time, we're seeing anywhere from 2 to 3 to 4% of that in total defaults in non-performance. So we're looking at stuff. I look at stuff that people haven't paid in 6 years, which is stupid. And I'm like, why didn't you do something? Well, we just got busy doing other things, or this portfolio is really the tail end of the trade. We focus on the bigger assets. We don't want to focus on the $50,000, $60,000 assets. You know what I mean? So yes, during COVID, it actually got very interesting because, banks weren't selling hardly anything because they didn't have to. Like they're just going to kick the can down the road for 12, 24, 36 months. But like I said, we just changed our strategy. Instead of targeting banks, we started targeting other investors. And there's a lot of investors out there that had stuff that when they needed to cash out, or they had worked the loan and got it reperforming, they're willing to sell off a performing loan at a double-digit return. So we just tweaked our business model a bit on how we originated deals. But yeah, we have started to see the last 6 months of last year, we started seeing an increase of product. It's always interesting when the banks start calling me and asking me what we're buying, or, hey, can you make us an offer on this? I'm like, well, that hasn't happened in a long time, and that happened before, at least a foreclosure tick up and stuff was expecting. They knew that they'd have to do something. So yeah, we've seen more inventory the last 90 days than we have seen in quite some time, but that we're always constantly buying and selling and going from there.
Does it matter to you economic condition then when you're buying or selling? So could I think about this as sort of a contrarian play? If we are expecting a recession, note investing is probably a good idea. Is that a fair thing for me to say?
It's a very fair thing to say because most people get, especially a lot of investors, they're more speculators. They buy something and they're looking to sell it in 6 months because they fixed it up and they don't maybe not want to hold. If you're speculating, hoping just on appreciation, that's okay. But I don't think we're going to see a lot of appreciation. And there's some markets that are still doing well. But here's the thing: I don't mind the asset if the value of the property drops 10, 20, 30% because I'm usually below 60%. So I'm still sitting in a spot. I'll write it out. I'll hold that note for 24, 36 months until the value comes back up and be okay and just write it out. And just know that, hey, we're going to modify. We'll keep this. If they're not going to play ball, we'll foreclose and we'll sell it, or we'll just turn around and add it, add it to a rental portfolio if we want to. I don't really like to do that because that creates a lot of jobs, but then just keeping the stuff around for a little while. We have to do it for a temporary, or turn it into a short-term rental, or find like an executive housing. We've done that before where it was 90 to 120 day short-term rentals in a lot of cases.
Yeah, if you're going to work out the loans anyways, and that's the primary strategy that you're pursuing, does the value of the home matter that much? I mean, how many people that are not performing on the note are thinking about strategic defaults?
Yeah,
not many.
Not fair to say? Yeah, some are. I mean, some aren't. It all depends on the individual investor's strategy and where they're buying. Like I wouldn't. You got to know what's going on in the state, because some states can take longer to foreclose. So that has a big action. And then your days on market definitely determines kind of strategy. Anything longer than 6 months of days on market was kind of we put a kibosh on buying that portfolio, or we reduce our bid on the front end side to make it more worthwhile if we know we're going to end up holding on it, especially if it's going to be an active foreclosure that we know the borrower's not playing ball, the foreclosure's already started, and going that route. You know what I mean?
Gotcha. Lots of opportunity here.
There is. I mean, that's the great thing. I mean, here's the thing, everybody. There's more opportunity now in a bear market than in a bull market in a lot of cases, especially if you're looking for distressed assets. There's a lot of people out there hurting. I make the joke here. We don't be afraid to see if we see ourselves in a garage sale economy. Back to 2007, 2008, you had garage sales, estate sales. People were selling off all the toys that they bought when they refinanced out their loan. Well, we're starting to see an uptick in garage sales, flea market listings, and stuff like that. If people are trying to survive to pay for the month that's left over at the end of their paycheck. If things getting more expensive, people are eating out less, and that means you have more of the service industry struggling because they're not making as much in tips. It's all interchangeable. Interest rates, dropped down a little bit there for you, but that doesn't mean people aren't struggling to get by.
Yeah, it's an interesting aspects. I think a lot of investors that we follow, or a lot of folks, are waiting for this wave of distressed assets that I keep explaining to people. I don't know when that's coming, because you, me, and everyone around this table are sitting here waiting for distressed assets. Like it's chicken and egg kind of thing going on here, where there aren't distressed assets if there's enough dry powder there for people to take them down. They don't exist.
Well,
however, in your spot, there's always some distress.
Yeah.
And it's just a matter of finding it and working it out.
Well, and that's the thing too, as I say, is that we see deals 6 to 12 months of your traditional property investors. So while you keep waiting for that REO portfolio, 70% of what would have been REOs has probably got gobbled up by note investors and worked out. So it never ends up at the REO market or distress. I mean, you can just look across the country. Yeah, foreclosures might be up a little bit, but they're nowhere near what they were beforehand. I don't think we'll have near the detriment, the destruction that we saw like back in 2010, where we peaked at 15 million homeowners underwater. I don't think we're going to see that. We'll probably get 7 to 8 million is what I'm expecting. But that's still, if you're waiting for REOs or foreclosures, you're probably not going to see a lot of them unless you've got an inside track. And we see them. If we want to turn it into a foreclosure, we can, because we foreclose. Otherwise, we'll just keep it and hold it for cash flow, and then sell the note off at a premium later on.
Don't sit around waiting for this stuff. It may not be coming. It's sort of our cautionary tale here. Find a different way to generate some income, and this could be a great option.
Subject to investing is another strategy that's really good. Dealing with distressed borrowers who you can take over that mortgage. That's a great strategy. Lease options in states outside of Texas, or wraparounds. I mean, those are the things that we target. I mean, if I get a list, I'll give you another funny here. When we get a list in from a bank, whatever I can't buy, we immediately send a letter out trying to do a subject to deal with the borrower as well.
Okay. Excellent. So you got to be more creative in this environment. You can't sit at your desk all day waiting for magic opportunity to be dropped on. It's not going to happen.
Yeah.
Got to get out here and make a strategy happen. Your strategy is almost agnostic to economic conditions. If there's more inventory, great. You could probably be maybe you're choosier. If there's less, then you find a different strategy that kind of makes sense. But it always seems like it's active. And that's a really good thing.
And the nice thing about note investing is I'm buying in about 20 states. So like most people like to do it in like their backyard, and that's okay in some cases. If you're in Ohio, Michigan, Indiana, yeah, you're going to see plenty of stuff up that neck of the woods. But if you're in an area that has no inventory, you can't really wait for the best deal in your neck of the woods. You got to get outside of it. And with the tool of Google and vendors to help you with values and property inspections, you don't have to do it all yourself. So if I'd have been just waiting to invest in Austin, Texas, I'd have gone bankrupt a long time ago.
That would have been pretty tough over the last few years.
Exactly.
To do that in Austin for sure.
Yeah.
Where can folks find you, Scott? For those that are not watching, Scott is literally wearing his podcast on his head and on his shirt. Is that the best place for people to start to kind of track you down?
Yeah, you can go to the mothership, our website, weclosenotes.com, hosts our podcast, talks about the different training stuff that we do out there. But yeah, we've got the number one podcast, number one YouTube channel for note investors out there. Over 730 episodes, over 1 million downloads, and we really try to crank out almost a daily episode, teaching some niche, some aspect of note investing. I mean, you're not going to learn everything about note investing in a 1-day or 3-day workshop. We have those, but it's a constant thing. The market's constantly moving, so we spend a lot of time focused on, hey, how do you tweak it? How do you approach this market, or how do you approach this strategy as things change out there? But yeah, check it out. But if you're listening to this or watching this, make sure you reach over and hit that subscribe button. Brandon is doing an amazing job here on the Retiring Real Estate Investor. Hit that subscribe button, and then we love to hear from you as podcasters. So make sure you leave a 5-star review. He's kicking ass and taking names, and we want to hear it.
Forget asking for people to do things for me. Thank you, Scott. I should do better.
You're welcome.
We'll get better. We got some ways to go. Scott, thank you so much. This has been awesome. I've learned a lot. I will not go to my bank, or maybe I will, and we'll record that and watch them yell at me. That could be fun. We could put that on your show. Look at this guy.
Here's one thing. If you have a smaller bank, it's got more than 5 branches, it might be worth going and knocking on the door. Hey, do you got any non-notes? I mean, where's home for you right now? Where's home for you, Brandon?
I'm calling you from Milwaukee area. I'm in an area called Pewaukee.
And I know that.
There's a bank around the corner, Waukesha State Bank.
Yeah.
Yeah. I mean, there's only about 5 or 6 branches that they have. So, hey, that could be kind of fun. Maybe we'll record that.
You might be. But here's the thing, too. If you got anybody looking for commercial deals, a lot of banks will sell a one-off commercial note. It's more valuable to do that versus a residential. So if you like commercial, we buy commercial notes. And if it is a commercial note with usually over $1 million balance or value, the bank might just finance that non-performing note sale for you.
Oh, I'm excited. Guess what's on my way to my son picking him up from school? Waukesha State Bank.
There you go.
I got a little time.
You got a little time. Call them up and then, hey, do you have a tape? Who here handles your special assets? You walk in there and be like, huh? Okay.
Oh man, if I have a $1 million commercial mortgage note next week, we're gonna have to talk about that.
I'll be back on. We can do the negotiations here on the podcast.
Yeah, let's do it. We'll do it live. We'll go through it live.
I gotta tell you a funny story before. I was doing a podcast one time, and one of these big HUD trades had gone through a couple years ago, and I actually said I'm gonna find out. So I called the hedge fund in New York and left a message. And I'm recording a podcast. And in the middle of the podcast, they call back. So I'm literally talking with a trader on this like $26 million fund. And they're like, oh, yeah, we expect to do this and that and this and that. And I'm like, oh, that's interesting. You got any one-offs? They're like, we won't have any one-offs for 12 months till we get beyond. So, well, give me a phone call. I'll take your crumbs and go from there. So you never know what you'll find, man.
You never do. This has been awesome, Scott. Thank you so much.
Thanks, man. Thanks for having me. It's been an honor, bud.
Awesome. Thanks, everyone, for listening. And listen to Scott. Like, subscribe. Please leave a review. We'd love all that. Until next time, everybody, thank you so much.